Okay, so I guess I'll go ahead and get started. It sounds like there was maybe some delays or confusion kind of getting started, but if it's okay, it sounds like a couple of people are on this morning. So glad you're able to join us. I'll go ahead and just jump in. Feel free to plug in any questions as we're going throughout the program today, and happy to answer those at the end. But welcome. My name is Scott Nelson. I'm with Legacy Financial Group, and today I'll be your guide as we discuss navigating tax season with a little bit less stress. I'm a financial advisor here in Des Moines with Legacy, and so in addition to serving and advising clients for over 30 years, we have the pleasure of partnering with local employers and EFR and delivering financial education programming throughout Central Iowa. As an independent investment advisor representative, we take great pride in our freedom of thought and fiduciary duty to always work in clients' best interests with true independence and no product bias. We're not lawyers or accountants, and so we're not making any specific individual tax advice today. So please consult your tax advisor for any specific situation that you have. But today's program is going to be strictly educational around tax planning. So is anybody stressed, or anybody get stressed around money or maybe confused around tax season? Well, stress is a common response to the unknown. So when there's something out there that we just don't quite understand, it creates anxiety and stress. With about 3.7 million words explaining the US tax code, it's really no surprise that there's a whole profession dedicated to just taxes. However, most of us have primarily W-2 income from salaries from jobs that we work at. And so this really helps simplify things, but still a little guidance and explanation is still absolutely needed to understand our income taxes. So today I hope to bring a little more clarity and confidence in your financial life as it applies to tax planning. So tax planning is different than tax preparation. We're in tax season right now, and so a lot of us are going through tax preparation. We're preparing to file our taxes, but we're really preparing to file what already happened in 2021. There's a couple of things that can still impact your taxes for last year, but pretty much most of it is done. So tax preparation is just really completing what's done. Tax planning is looking a little bit about last year, but really looking more so about this year and 2 years from now and 5 years and 10 years from now. So today we're going to talk about taxes. We're going to talk a little bit more about understanding income taxes. We're going to talk about Roth IRAs and HSA or health savings accounts. We're going to talk about contributing to either the Roth or traditional side of the retirement system, and we'll have some time for questions as well. So does anybody know how much you paid in taxes last year? If you filed your taxes, maybe that's top of mind, but for the average American doesn't really know that figure top of mind. And you could probably tell me what you made last year, what your salary or income was, but you can't tell me the tax you paid. And really, this is due to the power of payroll deduction, right? Our taxes are out of sight and out of mind. Well, maybe you're thinking, hey, I didn't pay any taxes last year. I got money back, okay? Well, that's called intoxication, okay? It's the euphoria of getting a tax refund, which lasts until you realize that that was actually your money to start with. Here's an idea. Instead of a tax refund and planning on a tax refund every year, which really is a free loan to the government of your money, why not use the power of that payroll deduction, that out of sight, out of mind, use that to your advantage and increase your retirement contributions? Or take that refund if you've gotten one from last year or planning on getting one this year and look at funding your Roth IRA or an HSA if you have that available, or a 529 college plan and have all these grow tax-free. We still have until tax filing deadline every year to make those contributions for actually the previous year. This year, with Good Friday being on the 15th, the tax filing deadline this year is actually Monday, April 18th. So, has anybody ever heard of Tax Freedom Day? Okay, Tax Freedom Day is a national day that's figured every year. It happens to be on April 18th as well this year. But Tax Freedom Day that's the day that we work every day up until that day each year. And that's really a representation of how much goes to taxes, okay? So that's a representation of taxes in our lives that we're working up till April 18th every year in Iowa just to pay for taxes, okay? Anybody heard of tax freedom hour? Tax freedom hour, you could actually calculate that. It'd be about 10:45 every day. So we work till about 10:45 every day just to pay for taxes. So to avoid that, just start coming in about 11. Anyway, in all seriousness, a significant part of our income goes to taxes. And so doesn't it make sense that we spend a little time to gain a better understanding of our tax system? We live in a progressive tax society, okay? So our brackets, our tax brackets are actually based upon taxable income. So the more earnings, the more taxes, but only an amount above that benchmark is taxed at a new rate. So pretty much everyone knows really what their salary is and what they get paid, right? But however, understanding your tax brackets, we need to look at, and this is a 1040, Form 1040, Federal Tax Form 1040 that gets filed every year, but looks at, we start with looking at wages, okay? And this is the wages that's reported by the employer after our payroll deductions, okay? And this is why, you know, when we look at W-2s, that's our W-2 income is less than what our salary is, okay? For typical W-2 employees, deductions, you know, come in the form of like dependent care, flex spending, or health insurance premiums, you know, or employee contributions to the HSA or the HSA program, or a traditional side of the 401k. So all of these reduce our reportable wages, again, on that top line, okay? Then we need to look at adjustable income or adjustable gross income. If we've got any interest, that would fall above that as well. But then we have our adjusted gross income. And then from there, we take away our standard deduction or itemized deductions, okay? So then that allows us to finally get to our what's called our taxable income. So that's in a scenario of, say, somebody that has a $75,000 salary and maybe has $7,000 worth of payroll deductions, again, for insurance or dependent care or something like that. And then maybe it's taken $18,000, say, head of household standard deduction. That would get us to a taxable income of about $50,000, okay? So that's important to understand because, again, when we look at our tax brackets, here's an example, again, of our progressive tax system. It looks at, again, our taxable income of $50,000, and the first bracket, our first bracket is at the $10,000 bracket, okay? So everybody that has $9,950 of taxable income pays 10% taxes. Every dollar above that is going to be taxed at 12%, okay? And then any dollar above that gets taxed at 22%. So there's a difference between marginal tax rate. The marginal tax rate, again, is the rate that's above each bracket. And then the effective tax rate is actually our total. You take our total tax, divide that by your taxable income, and gives us an effective tax rate, okay? So if we have a taxable income of $50,000, it doesn't mean we pay 22% taxes. It just means that anything above that 40,525 is taxable at 22%, okay? So a little understanding and clarification on taxes that way. For the state of Iowa, there's actually some changes, but we have a progressive tax system in the state of Iowa as well. Again, a little different ratios here and tax rates, but we've always had a progressive tax system there. If you may have heard recently, there's been some tax law changes that are going to be effective in Iowa starting in 2023 and gradually getting Iowa to a fixed tax rate in 2026. So it's a gradual scale that'll switch from a progressive tax system to a fixed rate tax system. So that's helpful in lowering our taxes in Iowa. Another big change is in Iowa is that retirement income for retirees is planned to be starting next year exempt or have some exemptions associated with our retirement income. So that's really big for retirees. So when we look at tax planning, one of the main reasons to gain a better understanding of all this is when it comes to funding our retirement accounts. So when we have a better understanding of our individual tax system and our individual tax brackets that we're in, we have a lot more clarity around when we should be excuse me, when should we be paying our taxes? It's always better to pay taxes when our rates are the lowest. So if you're in a high income bracket, like right now, if you're in a high income bracket, or if you're in a higher income bracket in the future, then you'd probably benefit from paying taxes now, okay, and funding the Roth side of the world, okay? So if our income right now is lower, maybe we're in the first half of our career, and we anticipate, future pay increases, then contributing to the Roth side of the world makes a lot of sense, okay? Or if we, find that maybe we happen to be in a higher tax bracket this year due to like a bonus or a substantial commission check or something like that, or if your income raised this year, at some point during the year, you can make those adjustments. Or maybe if you have an inheritance, a taxable inheritance coming your way, you can make that deferment and change from Roth to traditional, say in your 401k, and then when your income goes down, you can go back to Roth. So again, it's good to understand this so you can understand where we're at in our tax system as far as when we should be contributing to the traditional side or the Roth side. And again, the traditional side is a pre-tax deduction, and the Roth side, we're paying taxes now, and we won't pay taxes in the future. So we'll take a little bit further look at that in just a second. One of the things to understand also is, does anybody remember the Tax Cut and Jobs Act of 2017? This happened a few years ago. It seems like old news, but it was actually a tax act that was implemented and lowered actually our middle brackets by about 3 or 4%. However, it's not a permanent tax change. It wasn't a permanent law. It was a temporary law. So, and again, this started in 2018. So from 2018 until 2025, okay, so we have a couple of years, our tax brackets are actually 3 to 4% lower. And right now, again, that is temporary. So in the future, in 2026, if nothing changes, if the government, now the government could vote to extend these changes come 2026, but I'm not quite feeling that with all the current situation with the government spending. It seems like they're talking about raising taxes. And again, it's already in the books for our current tax brackets to raise in 2026. So again, right now, everybody's in a lower tax bracket than we've seen in a long time. So we should really focus on utilizing some of these tax preferred accounts. So let's talk about the tax treatment on different types of accounts. So again, we all have tax-free growth. These all have tax-free growth, but let's look at each of these a little bit more. So the HSA, again, associated with a high deductible health insurance plan, has a health savings account attached to that we can utilize. It's the only account that offers a triple tax benefit, okay? So what that means is that it's a tax deduction when it goes in. As long as it's invested, it grows tax-free. And then as long as it comes out for qualified medical expenses, it's not taxable upon a distribution as well. And also the Roth IRAs, those again are after tax and grow tax-free. The traditional retirement account, it's a tax deduction now, okay? If our income was higher, we would need that deduction now, but in the future, we're gonna pay taxes on that. And really the HSA and the Roth IRAs are extremely underutilized. So the HSAs typically aren't thought of really as a retirement tool, but it can really make a huge impact in controlling our future taxes and also help with combating the more than likely higher costs of healthcare in the future. So, right now when we're younger, maybe have a little less health expenses versus when we're older in retirement and have likely more health expenses and health costs a little higher. It's good to utilize these HSAs account. If you could, get in a position from a cash flow perspective to just treat this HSA also as like a 401k or retirement account and just contribute to it and not take out the distributions from it for a long time, that can make a huge impact. The HSA can also, has flexibility though, can also be utilized as kind of like a backup secondary or third emergency fund. Because if you have an HSA and you're making contributions right now, but paying out of pocket for your medical expenses, as long as you keep those record of those expenses that we're incurring out of pocket right now and let our HSA account grow, say 2 or 3 years from now, we've got, several $1,000s in that HSA account, but, we find that we need, access to those funds for whatever reason. Well, we could go back to this calendar year and take a qualified distribution of any medical expenses we incurred. We can take those in the future without any taxable event, okay? However, if we don't need those, again, we can let these grow and compound towards retirement, okay? So the other thing with an Roth IRA too is it gives us some more control in our tax brackets in the future. So with a Roth IRA as well, contributions, any money that we put into a Roth IRA, we can take those out and not have a tax event on that. Any contributions that go in can come right back out if we needed that. So again, you could utilize that in one aspect as somewhat of a secondary or third emergency fund. But really the best use of a Roth IRA is that compounding tax-free growth that we'll utilize after age 59 and a half into retirement, okay? But again, the Roth IRA and HSAs give us more flexibility if we needed access to funds right now versus putting everything all in the traditional bucket or 401k bucket, okay? And a lot of people, in March of 2020 when the coronavirus happened, everybody shut down and locked down, and there was a lot of people that needed access to additional funds because they didn't have an emergency fund built up, and so they started tapping their 401ks, and that's a bad, usually bad choice because there's tax consequences that go along with that. So again, let's look to the future, because we want to be understanding this helps us build more of a tax diversified portfolio. Because let's look forward to the future, say in this scenario, everybody fast forward to you're retired, okay? You're retired this year. And looking at what our income is, we want to take a look at, say we're single and we need taxable income. And again, we'd have Social Security, so that would be an income that we have available. Above and beyond that, say we need $40,000 to make our lifestyle run for this year. And so we would be taking out of our traditional 401k or traditional IRA side of the world, okay, at $12,000. So that's the plan. But then, well, what if there's a big vacation that we plan on doing, or we have a furnace go out, or we need a car, something else that we need happening this year? Well, if all we have is traditional retirement dollars, well, any dollar we need over this $41,775 is going to be taxed at 22%. You're going to pay 10% more taxes on those dollars above and beyond that due to our marginal tax rates, okay? So if we had, however, again, a medical expense or something, or again, had a large expense, and we had these Roth and HSA buckets, well, we can take out of those tax-free and have a lot better control of our taxes. And in that scenario, never go above that 12% tax rate. So again, understanding this helps us to build tax-efficient portfolios so we have much more control of our taxes in the future. So when we look at Roth IRAs a little bit, let's talk about contribution eligibility. Are you eligible to contribute to a Roth IRA? So in the Roth side of the world also, there's the 401k side. Some 401ks have a Roth available in them, and it's good to utilize those as well, depending on our income. But the Roth IRA is outside of our 401k. That's an individual plan, that retirement plan that you could manage or have an advisor manage for you. That has a little more flexibility than being wrapped into the 401k, okay? But are you eligible? Well, kind of depends on income. We have to have earned income. If you don't have any earned income, you can't contribute to an IRA. So once you have earned income, you can contribute. However, if you have a non-working spouse, there's also a contribution for the non-working spouse as long as the household has income. There's a contribution limit, okay, as well. Up to age 50, we can contribute about $6,000. There's a catch-up once we're over 50 and over, we can actually contribute another $1,000 a year, okay, to that Roth IRA, depending on our eligibility for our income though. So if we're single and we have income of $100,000 or anything less than $125,000, you can contribute directly to a Roth IRA. It starts phasing out once we get above that income range, and again, married about 198. So if our income's less than that, then again, this is on our adjustable side. The adjustable, like we talked about in the tax brackets, is our adjustable income. If it's above that, then we can't contribute to a Roth directly, okay? So for high income earners that have more than the contribution limit, there's something that's called a backdoor Roth conversion. And this is how high income earners contribute to the Roth side of the world. It's a two-step process, okay? And so there's some tax considerations if you have an existing IRA. But if we don't have an existing IRA, we open up an IRA and we make a non-deductible IRA contribution, because you can contribute to an IRA. We just can't, these income levels here are for deducting it, okay? So since our income's higher, we're not deducting it. We're making a non-deductible contribution in the IRA with after-tax money, and then we just do a conversion in that same year, and there's no tax event on that because it was after-tax money, and then we do a conversion, and then it rolls to the Roth side of the world to grow tax-free. So again, lots of strategies out there depending on situation. So it also amazes me too, when you think about how many people, if we think about too, we all work so hard, right? Every day for the money and the income that we earn, but then, you know, once people make that money though, people don't always take the prudent steps to protect it and grow it. And it really amazes me that we put so much time in, but we don't really, you know, engage and take it much further to grow and protect it, okay? So when we look at HSAs, funding those typically defaults to cash, and a lot of people stop there, okay? It really takes another step to make sure that those HSA funds get invested. Sometimes that can happen within the account. Sometimes you have to transfer that to an HSA investment account. But because if we look at, there's a rule called the rule of 72. And it's kind of a simplified way to look at how money grows with compound interest. So you take 72 divided by the rate of return. So if we have cash, right, and right now you can't really find much cash for 2% return. We had a couple of years ago, and we'll likely return to that at some point in the future, but right now banks pay 0.00002, right, or whatever. They just don't pay a lot. But in a scenario where we're getting a 2% return, you take 72 divided by 2, and that's 36 years. It'd take us 36 years to double our money if we were earning 2%. So we really got to make sure we're engaging with our assets to make sure that we're growing them, okay? Bonds, typically a little more conservative investment, but better than a savings account, subject to interest rates. Right now, it's kind of a tricky world in the bond side of the world as interest rates are rising. But nonetheless, this is a scenario, 4%. It can take us about 18 years for our money to double, 72 divided by 4. For investing in mutual funds and stocks and ETFs, say an average return of 8%, 72 divided by 8, takes about 9 years to double our money, okay? Again, compound interest. Well, what happens when we have inflation, right? Especially for the cash side of the world. Right now we have inflation. Last month, inflation was 7.5%. So our money in cash, I almost think that savings account should list what inflation is on our statement, because you look at a savings account, it's like, oh, at least I didn't lose any money. Well, not in your statement, but we lost purchasing power, okay? So when we have inflation, we've, especially over the long run, and it's been 2-3%, we can plan on, you know, 3% or so for sake of discussion in the future. We really can't be invested in cash for the long run. We need to be invested in cash for our emergency funds to have that liquidity. But beyond that, we're gonna need to make sure our money's put to work. So that looks at what's the best or the appropriate use for our next dollar. You know, when we look at planning around taxes. Well, first we got to make sure, again, like we just talked about, we got to have an emergency fund. We've got to have just cash ready to go if we have a furnace go out or a car repair or something like that. But then the next best use of our investment dollar is to get the full match at our retirement program. If you have a company that say matches 4 or 5%, we want to first make sure we're doing at least 4 or 5% to get that match, okay? Beyond that, we want to make sure if we have any high interest rate debt in our life, we want to make sure to get that paid off, okay? Because it's having high interest rate debt is kind of like having holes in our retirement bucket, right? In our net worth bucket, we've got holes coming out of the backside in high interest rate, we're just not going to accumulate the wealth. So the next step is, again, pay off high interest rate debt. If we have an HSA available at work or through a spouse, their plan, take some time to really understand and ask questions around how that works, because most cases, not every case, but majority of cases, that's a better deal over the long run. So take a look at utilizing that also towards retirement. Next step beyond that would be to additional dollars, look at doing a Roth. Again, depending on our income, but look at doing a Roth. And if you can contribute to one, do so. And then also then after that, then look at going back to, once we fill up our $6,000, $7,000 in the Roth side of the world, in an IRA, now look at going back to the 401k and topping that off. Okay, so that way we're diversifying and creating diversified buckets of investments for future income. Okay, versus putting just every single savings we have in our 401k. That just leaves us a lot less flexibility in doing so. Okay, and this is what we just looked at there, was kind of a little bit of a look into what financial planning looks like. It's more than just investing, however. It's more about creating balance, okay? And trying to create that balance of paying for yesterday, at the same time enjoying today, and also saving for tomorrow. So we all have a lifetime of financial decisions that we're gonna need to be made, right? And we all start off by doing nothing, right? Usually it's because we're out of college, first job, don't have any money, so it's hard to do much planning, okay? But at some point in our lives, as you know, work progresses, we start saving a little bit, and maybe have kids or married, or job changes, or maybe there's later on in life we receive an inheritance. At some point there's a life event that happens that opens our eyes to our finances and has us starting to engage, okay? And we start digging in and start doing things, taking some action, start reading, start researching online, and that's great. But also there's a wealth of information online, and that's great, lots of information out there, but then it's also confusing on what to do, right? You read one article that says do this, read another article that says do the opposite. So there's a lot of information out there, but once we get to the point where what we're learning kind of outpaces our knowledge on that matter, that's when we need to ask for help. We need to ask for help and engage in tax professionals and financial professionals to ask the questions in our financial lives that give us that more clarity and confidence. Because really everybody's financial life is kind of like a puzzle. Everybody has different financial puzzle pieces, but it takes gathering those all together and building a financial picture of somebody's financial life. Okay? So again, just like every other aspect of our life, though, unless you're specifically trained in that specific area of expertise, you're not expected to know everything about that subject matter. So again, it's okay to ask for help. The average financial planning client is actually about 62 years old, okay? And that's not too late to plan. However, everyone that I've worked with always says, oh, I wish I'd have started sooner. I wish I'd have known this sooner. I wish I'd have done this in my 30s, 40s, or whatever, because you have that time to make these changes, really make a bigger impact. And I think part of it, and I've heard a lot of this lately, is that people think of the financial industry, well, you've got to have a lot of money to work with a financial advisor. Well, that's just not the case. It used to be. There are firms out there that have minimums that are very high, but most times you can find a fee-only advisor that can work with you on a fee base to really help to clarify your financial life. So again, no matter how old you are, your financial future actually starts right now, right? Tomorrow is going to happen, whether we plan for it or not. So it's just that, those who plan for it, they just flat out do much better, financially speaking, in life than those who don't, okay? At Legacy Financial Group, we understand that everyone's personal situation is unique. And we really specifically, when it comes to tax planning, we really enjoy helping people to bring that clarity and confidence into their financial future, and take pride in our independence, our freedom of thought, and fiduciary duty to really help each client clarify their future. So the process of financial planning is really helping identify what path you're on as well, right? Financial planning helps to clarify the path that you're currently on, so you can understand at what point you have that financial independence to work because you want to, not because you have to, or what path you're on towards a retirement, a successful retirement. So that's kind of a little bit a look into what planning does. It also helps us identify what are some of the strategies that are available and that are unique to your specific situation, based on your company's retirement plan or your HSA program or dependent care or whatever. And if a spouse, same thing, if you've got different plans there, it really helps identify the unique situation and help improve financial trajectory of your financial future. So that's a short glimpse, I guess, what financial planning kind of looks like. So today, hopefully you found some value today in our short program about taxes and tax planning. But now it's time to put some finances in action, okay? Knowledge, I like this quote by Tony Robbins, is that knowledge is not power, right? Just having the knowledge alone, that's not power. Knowledge is only potential power. Action is power. Actually taking action and doing something on the information we've learned is power, right? So take a look at your tax return from last year, or the tax return, and maybe compare it to your tax return you're filing right now, and kind of understand where you're at with your tax bracket. And look at contributing, if you haven't already, contributing to the Roth IRA for last year. If you have an HSA, same thing. See if you can top that off if you haven't maxed it out. Because once tax filing season's gone, we can't go back and contribute. Okay, right now we can, but like we can't contribute to 2020 taxes. We can contribute to 2020 funds for our taxes. Okay, get a guesstimate of what bracket you anticipate being in for this year, and develop a strategy again around saving to maybe the 401k or the Roth or the HSA, or kind of develop that strategy to start filling up and diversifying your tax efficient investment portfolios. Take a look also and review your old retirement plans. If you had a job or two that had an old retirement plan, take a look at how those are set up and if those are being managed, right? It's good to be engaging in those plans. Make sure that they're on track with your current financial goals, okay? And also, again, take some time to clarify the path that you're on. Finances, again, can be very stressful for people, and it's because what I found too is that it's the unknown. It's like, if you don't know what path you're on, it can be very stressful. Once you clarify that, it just alleviates some of the stress in our financial lives to kind of know where we're headed, and also to identify some of the things that we can do to improve that. And again, ask for help, right? Just like anything, it's okay to ask for help. Look at your financial advisor or tax professional for some help. I've got time for some questions. If anybody is on that wants to type in a question or two, happy to address those today. If anybody has any questions about what we talked about so far today, or any other kind of tax planning financial questions, happy to address those. And or feel free to use me as a resource too, and jot down my email or phone number, give me a call, or shoot me an email. Happy to answer your questions confidentially offline as well. So, all right, so this is just kind of a short recap too on some of the EAP benefits that are available through EFR. Obviously, there's a wealth of information and wealth of resources available, specifically when it comes to finances. There's a financial consultation that's available through EFR, as well as some legal consultation as well when it comes to the financial piece of things. Okay? There's a newer app that's out there that's available as well. So if you can go out to the App Store or Google Play and download the app to engage a little bit easier with EFR on your mobile device. So there's also an Emotional Well EFR podcast that's available. You can find that out there on the EFR website. A lot of great information. There's a couple financial podcasts that Johanna and I have done as well, so you can look back at listening to one about just kind of engaging our overall finances, and one a little bit more geared towards retirement. And looks like there's some a future webinar is set for April 13th at 10 o'clock. So feel free to put that on your calendar. And the presenter's Jay Foot from Embodied Endowment, or Endowment Now, sorry. All right, well, that kind of wraps up our presentation today. Again, happy to be a resource for any questions. Otherwise, we'll wrap things up there. Thanks for joining us today, and have a great week.